So tonight we're doing chapter 3, and last class we talked about job order costing. This class is going to continue talking about that. It's just going to be looking at it like once everything's done, how does it flow through the different departments? How do we do the journal entries to move from raw materials to work in process to finished goods? So we're going to walk through all of that. So it should be pretty, easy because you've heard most of it, how to calculate it last week, you've done the homework. So now we're just kind of adding in how to do the journal entries. So, and it's not a very long chapter, so I'm not expecting that this is going to take too long to get through. So if y'all have any questions after, then you can come get with me. Okay. Okay, so we talked about the job order costing. So that just means that you have a costing system that's looking at the costs that are going into a particular job. And it's either for products or services or a combination of the two. And we're capturing them on a specific job. So maybe we have a job number that we're assigning all of these costs to. And then we have absorption costing. So the costing method that includes all the manufacturing costs. Remember we talked about the 3 things, the direct materials, direct labor, and the manufacturing overhead, which is both the fixed and the variable. So we looked at that formula. And last week we talked about the predetermined rate that we're gonna estimate, and we're gonna bring that in and use that number throughout the period in order to calculate the manufacturing overhead costs. Okay. And we'll look later in this chapter, we talked a little bit about sometimes we have too much, sometimes it's over or under, we have to make adjustments. So we'll look at that at the very end of the chapter. So we talked about the allocation base. And so remember, we were talking about some sort of activity that we're going to be using to calculate that cost. So maybe it's direct labor hours, it could be machine hours. And we'll say, okay, let's look and see how much is that total cost and how much do we expect for total labor hours or total machine hours, and we come up with that rate. So the predetermined overhead rate, this is the formula. If you, I'm sure you have it from last time because you need it for the homework, but it's the estimated total cost over the allocation base, whatever you think that allocation base is going to be based on those hours or whatever activity it is that you've chosen to use. So that's just a recap of some of the things that what we did last week. So we also looked at the job cost sheet. So the job cost sheet shows the materials, the labor, and the manufacturing overhead coming in. It gives you a total price. It can see how many of the products were produced on that particular job sheet. So then you can figure out, okay, so I made this many units with this total cost. You can figure out how much is it per unit. And then we can use that to help us with marking up for our sales or, looking at our total cost for the job. Okay, so we talked about raw materials. So raw materials are those materials that we're purchasing that we're going to use to bring into the product. So this is, if you're at a chemical plant, it could be those raw materials that you're buying that you need, that you're going to mix together to make a particular chemical. So those products, you'll have inventory on those products. And so you have to keep track of those and what's happening in that inventory of the raw materials. Then we moved into work in process. So it's gonna be a lot of this again tonight of what we're talking about. The work in process just means we're taking some of those raw materials and we're going to bring them in to make some sort of product. And then we're going to have labor that's involved. We have our predetermined rate for our overhead, and we're going to pull that in. All of that goes into work in process. So work in process is exactly that. It's in process. It's not finished yet. We're bringing in materials and labor and all that stuff during the period. So maybe at the end of the period, we still have, some left in there, but some finished and moved on. So next would be your finished goods, and your finished goods are what is going to sell. So this is in its finished state. So your finished goods are going to be what you're going to market and what you're going to sell. Those also will have their own little inventory, and you'll have your steps that you have to calculate in order to keep track what's happening in those finished good inventories. So all of these are asset accounts, right? We have a raw material, it's an asset. We have a work in process, also an asset. We have our finished goods, also an asset. That's what we're using, we're producing, and then we're gonna have finished goods we're gonna sell. And we'll move those into, when we sell, we move those costs out of those manufacturing costs into the cost of goods sold to match the revenues that are happening at that time when you sell. Okay, so cost of goods manufactured is just the goods, what the amount is that we're pulling out of that work in process, putting into finished goods. That's the manufacturing cost. So we'll have some in there that are left in work in process, and we'll have some that move on to finished goods. And we'll look at all that tonight and do the journal entries. So this slide is it's nice how it's broken out because it tells you what your costs are, breaks out those three things: raw material, your direct materials, your direct labor, and your manufacturing overhead. And then remember, we talked about the selling and admin expenses, that's something that wouldn't get brought in on the job, but it is cost to the organization, and you will have to bring that into the income statement on the financial statement, but you're not pulling it into the job itself. And so we talked a little bit about those income statements, and we show those revenues, and then we have those costs that are for, producing, or that contribution margin. Remember, we looked at all those different ones in chapter 1, how you can break down the income statement. And so after you have that, you have your gross margin. So you have all your costs up at the top, and then you have your selling expenses that come in underneath. So remember, if you just like a service organization, you wouldn't have those types of costs. You'll just have revenues coming in, and then you'd have your expenses. So so just keep in mind that there's a couple different ways we can break out the income statement. But these are not going to be part of your job. It's going to be your period costs that are separate. Okay, so the balance sheet, remember I said that these accounts are assets. Assets, liabilities, and the equities sections are going to show up on that balance sheet. So remember that formula: assets equal liabilities plus equity. That's what shows up on the balance sheet. So on this slide, it's showing you, okay, so here's your three asset accounts that are showing up on your balance sheet: the raw material, the work in process, and the finished goods. And then on the income statement, so when it's finished, we have income because we're selling. So that's your income statement. So you're going to have your cost of goods sold because we sold them. And it's also going to have that bottom part that has your selling and admin. Okay, so let's look at this example. We have two jobs, and we're going to walk through this to look at the flows so that we can do the journal entries. So we have job A. It's special minting of 1,000 gold medallions commemorating the invention of motion pictures, which started during March and completed in April. As of March 31, job A had been assigned $30,000 in manufacturing costs, which corresponds with Rugger's work in process balance on April 1 of $30,000. Okay, so we have that $30,000 that they say is in work in process. So we need to look to see when did the direct materials come out and all that stuff. So we're going to look at that on the next slide to show in work in process. Okay, then it says job B, in order for 10,000 silver medallions commemorating the fall of the Berlin Wall, was started in April and was completed at the end of the month, incomplete at the end of the month. So that's going to stay in work in process because it's not complete. So you're going to have those two things happening in work in process. You have multiple jobs in there. So let's walk through what it looks like when we go through the flow. So we have the purchase of the raw materials. Okay, so we're looking at T accounts. So when you have a raw material and you buy it, your asset is normally a debit balance. So you remember the T accounts from principles? We kind of did it a little bit in the very beginning when we did our financial review. The left side of the T account is your debit side, and the right side is your credit side. So anytime you see activity on this in words, just know if it's on the left, it's debit. If it's on the right, it's credit. So we're looking at our raw materials. When we buy raw materials, we're either paying them later, so we have a liability, which is going to be a credit, and we have an asset, which is the materials that we're going to be using later for our production. So that's a debit because it's an asset, right? So we can also pay cash. So we pay cash, we have a debit to materials, we credit cash because cash is going out. So we have two assets. We have a debit and a credit. So on this T account, it's only showing what's happening on that raw material side. So we always have two sides, but we're not looking at that. We just want to look at this one account. What's happening in this account? So we have materials purchased. We're buying them, it's a debit. When we go to pull that material, we have to credit the raw material account and move it over into the work in process. So we're crediting where it says the direct material in red. That's our credit for how much we pull. And then we're moving it over to work in process, and that's our debit. So we're going to look at the journal entry, but if you can know that, it'll be easier to do the journal entries if you know what's happening on the T accounts. So all we're doing is taking our material out and moving it over to work in process because now we're going to be using that product. We also have some indirect materials, which we talked about, that flows into the manufacturing overhead. So we will have a manufacturing overhead account that we have to capture those indirect materials, that manufacturing overhead. Remember we came up with a predetermined rate. That's going to be moving into the manufacturing overhead. So we're going to take out of raw materials any of that indirect materials that we're using. We'll have an estimate. We'll post that, and it'll be a credit to the raw materials, and then it'll be a debit to the actual indirect materials going into the manufacturer's overhead. Okay, so on April 1, Ruger Corporation had $7,000 in raw materials on hand during the month. The company purchased on account an additional $60,000 in raw materials. So it's telling us we had $7,000 already there. So we don't have to do anything with that because we know that it's there. We'll have to use it in calculation, potentially, depending on what the question is. But for this particular question, they just want to know what is the journal entry for the additional purchase. And it's telling us that we purchased it on account. So since it doesn't say we purchased with cash, we know the cash isn't going out. If we purchase it on an account, that means it's a credit account. So it's an accounts payable. We're going to have to pay them later. So that accounts payable is a liability. We are liable to pay in the future. So this is our journal entry. Raw materials we're buying, $60,000 debit. And then we credit the accounts payable $60,000 because we have to pay them later. During April, material requisition forms were prepared to authorize withdrawing $52,000 in raw material from the storeroom to use in production. The raw materials included $50,000 of direct and $2,000 of indirect materials. So they're telling us how much we're pulling out, and we're going to have to do a journal entry for that. All right, so when we go into work in process, it's going to be a debit because we're moving it from one asset to another asset. Okay, so we're going from raw material to work in process. So work in process is going to get the debit. If you have to reduce your materials, you do the opposite. If it's in there as a debit, now we're crediting. So that's why we're crediting raw materials $52,000 because it's telling us that we're pulling that much out total. So raw materials has part of it is direct, part of it is indirect. So remember that indirect flows into the manufacturing overhead. So that's where we want to make sure that that goes. So we have work in process 50, that's a direct material. And then we have that manufacturing overhead 2,000. And then we have the raw materials, which we're pulling out. So we're doing a credit for the 52 for the whole thing. Okay, so now we have labor. So we pulled the material out. We're starting to produce on that particular job. And now we need people to work on that job and do their part. So when we have the timesheets come through, we're going to have to pull in to those jobs. So usually on the job like sheet that you're filling out, we'll have the job number that you have to put, and the time will flow into the job cost. So the work in process is going to get all the labor while it's not complete, while it's still in process. So the debit is going to go into the work in process on that job cost sheet for your direct labor that's going in. And it says salaries and wages payables because when you get paid, normally it's not that day that you work, right? You're not getting paid cash every day that you work. It's usually every week or every 2 weeks, sometimes monthly, but a lot of times it's every week or every 2 weeks. And so they're going to set up that payable, which means they're liable to pay these salaries in the future. Since it's a liability, that's your credit. So you're setting that up as a credit for your direct and your indirect labor. So a portion, your direct labor that's getting tracked on a job, is going into that work in process for that particular job. The part that you can't really track is going to flow into your manufacturing overhead. So we're doing a credit to liability because we have to pay all the salaries. And then part of it's going to go to manufacturing overhead and part of it's going to work in process. Okay, so y'all following this so far, how it's flowing through? Okay. All right, in April, the employee time tickets, which provide hourly summaries of each employee's activity throughout the day, included 60,000 recorded for direct labor and 15,000 for indirect labor. So now we have numbers. So we're going to add that together. It's 75,000 of total labor that we have to pay out, but not all of that is going to get costed to a job. Some of that's indirect. So we're going to put that into the manufacturing overhead. So we have work in process for the direct labor portion, which is 60,000. And then we're going to debit manufacturing overhead for the 15,000, which is the indirect labor. And then we're going to set up the salary and wages payable for 75,000 because that's how much we have to pay out. That was the actual salaries that we have to pay. Okay, so here we go. It's showing us our payable for our liabilities for the salaries we have to pay, showing us our work in process right now has our direct materials and we have direct labor. We haven't brought in that manufacturing overhead yet. But this manufacturing overhead account is capturing all of what's actually happening. So remember, we had that predetermined rate that we're going to use for the job during the period, but each job is going to catch that actual material for your indirect material, your facilities, and we'll walk through some of those examples because they'll have it in just a minute, which is other overhead, how it has it on there, and your indirect labor. So you can see how this is flowing, right? Out of your direct materials, out of your labor, setting up your labor and putting it all into work in process. And then the indirect portions going to manufacturer overhead as a debit. Okay, so here's the other. So assume that Rugger Corporation incurred the following general factory costs during April. So we had utilities of 21,000, rent on factory equipment, 16,000, miscellaneous factory overhead costs of 3,000. So these costs are all our overhead costs. So the overhead cost has that indirect material, indirect labor, and then these other costs that flow into manufacturing overhead. Okay, so we're going to add all of those up, which is 40,000, and we're going to debit manufacturing overhead, and we're going to credit accounts payable. And the reason we're crediting accounts payable is because we have to pay for those bills. So the utility bill comes in, the accounts payable clerk is going to enter that into the system. So remember, I said that each vendor that you have has like a number or a name that identifies who they are. So they'll just enter the bill in, and it'll, they'll put the amount in for 21,000, and the system is going to automatically put that entry in and go to accounts payable for you. So you won't have to do a journal entry for these types of expenses. Usually the software is doing it for you. In class, we're walking through so you can understand it. But I want you to understand what's happening in a workforce, right? So you're not actually doing all these different journal entries. So you'll see the accounts payable, as a whole. It won't be just 140,000. You'll have 3 different entries for 3 different vendors. So that way you can run your report and see who you owe. Okay, does that make sense? Okay. So now we brought everything in. We have our direct materials, direct labor, and we have our manufacturing overhead. Now, this applied that we're looking at here on the screen, the applied overhead, that is our predetermined rate that we had. So we're going to do an entry to put work in process. It's going to pull over the manufacturing overhead based on what activity base we set up. So we're going to do an entry to put manufacturing overhead estimate into the work in process for the job, and we're going to credit manufacturing overhead. And at the end of the year, we're going to look to see, okay, what was actually our manufacturing overhead, and then how much did we estimate? Are we over or under? And then we have to deal with that over or under because you have to clear it out. Okay, assume that Ruggers Corporation's predetermined overhead rate is $6 per machine hour. Also assume that during April, 10,000 machine hours were worked on job A and 5,000 machine hours on job B. So we have a total of 15,000. So we have 90,000 in overhead. So we should be taking the $6 and multiplying it by the total machine hours of 15,000. Okay, so we have $6 per machine, oops, sorry. 6 hours, $6 times the total, which is 15,000, to calculate what the estimate is. Okay, so 90,000 in overhead. So we have to put that to work in process. So now here is our journal entry. We just looked at what it looked like on the T account. This is the actual journal entry. So for the work in process, we're debiting the 90,000 and then we're crediting the manufacturer overhead for 90,000. Okay, so manufacturing overheads capturing actuals and then it's being offset by those estimates. Okay, so y'all with me? Okay. All right, so now we have non-manufacturing costs. So we have the salary expenses of employees who work in marketing, selling, or administrative capacity, and they're going to be called period costs. So we have to capture those expenses, but we're going to do the journal entry not into the job itself, okay? But we still have to capture that. And then we may have some advertising expenses for that period as well. So we can't usually sell the product without some sort of advertising. So we're going to have some expense there. All right, so here's some examples of those. So we have Ruggers Corporation incurred $30,000 in selling and admin salary costs during April. The following summarizes the accrual of those salaries. So remember, if we're not paying yet, we have to accrue those expenses for the period in which they happened. So we're going to set up the journal entry. We're going to debit an expense account. So we're debiting salaries expense, 30,000, and then we're crediting the salaries payable because we're going to have to pay that in the future. We'll be liable to pay it in the future, 30,000. So we're just doing a regular journal entry for an expense. Nothing fancy is happening here with the job. We're just doing the regular journal entry. Then we have depreciation on the office equipment. There was $7,000. So we have to set up our depreciation expense. So depreciation expense, it's going to be debited for $7,000, and then we use that contra asset account. It's just the offset to reduce the asset, but it doesn't go in the asset account. So in principles, when we do depreciation, I talk a lot about that. So when you buy equipment stays that price the whole time. So it doesn't change, unless you do some sort of adjustment to the asset itself, but you don't want to depreciate it there. You're just going to have the full amount for equipment sitting there. And then the offset of that is called accumulated depreciation, and that's going to be your credit. It's called a contra asset account. So it's going to show up on your balance sheet under your asset section, but it's reducing your asset. So you'll have an asset number, let's say it's 100,000, and then you have this entry for 7,000 for your accumulated depreciation. So it'll show your equipment, 100,000, and then it'll show accumulated depreciation, usually in brackets, 7,000, and then it shows your net book value, which is the difference between the two. All right, so we have our depreciation expense. And then we have advertising, which was 42,000. We had other selling and admin expenses that totaled 8,000. And so we have to put those in the books, and usually they're separate accounts. So we're going to have advertising expense debit for 42, and then other selling and admin for 8,000. And then we're going to set up the liability for that as well. So we have accounts payable for the total, which is 50,000. Okay. So now we have work in process that we've been working on for that period. And now we have part of it that's completed. Maybe one of the jobs complete and we got to scoot it out of work in process. So we have to do all the calculations of the material and the labor and the manufacturing costs to capture everything. So once we know, okay, this is everything that we've put onto this job and this job's complete, now we can move it out of work in process as a whole. So you take your whole cost of manufacturing and you credit work in process and you move it into finished goods. Okay, so that's what this is showing here. We're crediting the cost to work in process and we're moving that cost over to finished goods. So it's just taking the total of the job. So we've been following two jobs. We have job A and job B. Okay, it's telling us job A is completed in April, job B is incomplete at the end of the month. So the following transfers the cost of job A from work in process to finished goods. So we would have to go back and do the calculation to see where the 158 came from, but it's from their direct material, direct labor, and the manufacturing overhead. Okay, so we're gonna debit the finished goods because now I have a product that I can sell. It's gonna go into that inventory that I can sell now. And then I have my work in process that's crediting. So now I'm reducing the work in process because it's finished in there. It's got to be moved out. So we credit in work in process. B is not complete at the end of the month. So the cost stays in work in process. We're not going to move it out. We'll just carry it over for the next month. It'll be the beginning work in process balance. So if a balance sheet were prepared at the end of April, the cost accumulated thus far on B would be 72. So it's just looking at what we had as total costs. We had A and B. So we pulled A out and now what's remaining is B. So we have work in process for B, 72, and we'll have finished goods for 158 on the balance sheet. Okay, and this just shows you on the T account what's happening. So here is our credit for finished goods if we sell them, and it's going over into cost of goods sold. So it's maybe not all of the job. Maybe the job produced, 1,000 units and we didn't sell the whole 1,000 units. So just because we put all the costs in the finished goods doesn't mean that that's going to come out when you sell. You might be only selling a part of it. Does that make sense? So you're going to have that inventory running balances that you're going to have to figure out. Okay. All right, so this is when we make the sale. For Rugged Corporation, we will assume 750 of the 1,000 gold medallions in job A were shipped to customers by the end of the month for total revenue of $225,000. Because 1,000 units were produced and the total cost of the job from the job cost sheet was $158,000, the unit product is $158. So remember, we have to figure out what it is per unit because we're not selling all of them. So the job told us a few slides ago that we were producing 1,000, and we know that job A was 158,000. So if we produce 1,000, we had 158,000 total cost, you just divide it, and then you get your cost per unit. So we have product cost was 158 per unit. We're selling 750 of those. So that's how we're going to calculate our costs. And then it tells us the sales number. It doesn't give us a number per unit. It just says we sold 750 for the 225,000. That's your total. So you don't have to calculate anything there. All right, so the journal entry is going to have two parts when you sell a product and it has a cost. It's a couple of things you have to do. You have to remove that inventory off of your books, but you don't want to remove it for the sale price. You want to remove it for your cost. And that becomes what? Your cost of goods sold. And then we also have to record the revenue, but we don't want to record the revenue at the cost. We want to record it at what we sold it for, which hopefully is more than what your cost is. Okay, so you have two parts. So the first part, record your sale. It's telling us that we sold to customers. Let's see if it tells me on credit or something. It doesn't tell you that. Doesn't say that we received cash, so we're just assuming that they bought on, oh, it does say all sales were on account at the very end. So we know we didn't collect any cash. On account means it's on credit. And so now we have an accounts receivable. So remember, accounts receivable means that we're going to receive the money from this account in the future. It's an asset account. All right, so we're debiting accounts receivable, 225,000. And then we're crediting the revenue, the sales for 225,000. Then we're going to take care of the cost part because I have to take that inventory off. I don't want to show that on my books if I don't have it anymore, right? You want your inventory to be right. So I'm going to take 750 units out of finished goods. So I'm crediting that asset account. So I have them sitting there as a debit, and to remove it, I gotta do the opposite. So I'm crediting finished goods. That is my cost of goods sold. So it's 158 times 750. That's how I calculated it. And that goes to cost of goods sold. All right. So we have cost of goods manufacturing, everything's going in, and that's everything for the job, but not everything's coming out. Okay. Because we only sold 750. Does that make sense? Y'all with me? So two parts when you sell. Okay, so now we're kind of recapping again. So we have three types of costs. You probably heard me say this probably 1,000 times. Direct material, direct labor, and manufacturing overhead. Those are your three pieces that are going in. Okay, the schedules, they're going to calculate the cost of the raw material, the direct labor, that we use in the production, and the amount of manufacturing overhead that was applied to production. And then we have the manufacturing costs associated with the goods that were finished during the period that are going into the finished goods, okay? All right, so here is the formulas when you have to calculate what's moving, like when you have your numbers and you actually have to calculate those over into what's happening. This is how you would calculate it. So I have this on Moodle, the PowerPoint slides, if you want to get back to these formulas, if you need them when you're doing your homework. So we have raw material purchased during the period, and they're added to the beginning raw material. So I have this much material, I'm buying more, so I'm adding 2. So I have now this much available that I can pull from. Does that make sense? I have some that I was already on the shelf, and then I'm buying more. So I have this much that's available. So we have beginning raw materials inventory. We're purchasing more, and then that equals the raw material that's available to bring into production. A lot of times they will tell you, this is what you have left in ending material. They won't tell you how much you used. If they do that, you just subtract what's ending to get what's been manufactured. If they tell you how much has been manufactured and they want to know what's the end, well, then you just subtract what's been manufactured from available to get the ending inventory. Does that make sense? So you can look at this formula, beginning plus purchases gives you what's available. And then you take out the ending inventory, or you can take out the materials that were used in production and get the ending, or you can take out the ending and get the production. Got it? All right, so whatever was used in production, that's what we're pulling over to manufacturing costs. Okay, so we have our direct materials. That's one piece. Now we're gonna look at direct labor. So we pull in direct labor in. The exact same things kind of happen. We're gonna add that direct labor piece in, that indirect manufacturing overheads coming in. So we have two pieces to the labor portion. And that's giving me my total manufacturing cost. It's not done yet. Usually there's that manufacturing overhead that we got to pull in as well. So now we have our direct materials, and we have direct labor, and we have indirect labor with the manufacturing overhead. So we calculating all that up to get the total manufacturing costs. Okay, so now we have the third piece. So if you look at this middle section right here, so now we have direct material, direct labor, and we have manufacturer overhead applied. Okay. So now we have the total. Once we have the total of what we're using on that job, it's pulling out, going to work in process. Work in process, remember, it's going to show up as its own account. So you may have something that was in there, like in the beginning of the month. So we'll have a beginning balance. Then we add our manufacturing costs that are coming in for the new job that happened during that period to give us the total work in process. Okay, then at the end of the period, we're going to look and see what's left in work in process, what's been pulled out of work in process that's been completed. If they give you ending, you would just subtract it to come up with what was actually moved over to finished goods. If they say this much was in finished goods, how much was the ending work in process, you would do the same calculation. Take your beginning plus what was added, and then you subtract the cost that was manufactured, and you get your ending work in process number. All right, from the work in process, then we go over to finished goods. Again, this is another asset account that you're keeping track of that inventory. Potentially you have some product that wasn't sold during the period that's carried over, so you have a beginning balance. So we take the beginning goods of inventory, we add in the cost of goods that was manufactured. So that's just what's coming out of work in process into finished goods to get what's available. So I had this much product. Now I'm adding completed products to it, and that's what I have available to sell. I take out what my ending is to get what I sold, or vice versa. If they say this is your cost of goods sold, what was your ending finished goods? Then you would just swap that bottom part out and you would subtract the cost of goods to get the ending inventory. Okay, so it's the same, you see how it's the same thing for each one, like the direct material, the finished goods, and the work in process is all the same on how you calculate it. All right, so y'all ready to look at an example and go through some numbers and calculate? Any questions? You excited?
So excited.
Okay. So we have beginning raw material inventory at 32,000. During the month, we have 276,000 of raw materials that we purchased. And then at the count at the end of the month reveals that we have 28,000 of raw material, which is still present. So I have beginning balance, I've purchased. So am I adding or subtracting? Adding. I have what's available, and then it's given me what my ending inventory is. So I need to calculate what was being used, what materials were being pulled out. So what is the number? Do the calculation, it's quick. So what am I doing? Tell me what's, I'll put it in the calculator. What are we adding?
32,000 plus 276,000 minus 28,000.
And so your answer is 280,000. So that's what I have that I've used in direct materials is the 280,000. And they have a slot in here if you need to get back to it. All right, so now we have direct materials used in production at 280,000. We also have direct labor that was 375,000 and 180,000 of manufacturing overhead that was added to the production in the month. So what are the total manufacturing costs incurred for the month? So they're giving us the three pieces we need: direct material, direct labor, and manufacturing overhead. So what do you think we're going to do to calculate? Add everything together, yes. So when you add it all together, we get 835,000. So it's B. Okay, beginning work in process was 125,000. Manufacturing cost added to production for the month was 835,000. So we just calculated that. There were 200,000 of partially finished goods remaining in work in process. So they're not finished. What is the cost of goods manufacturing during the month? What is the cost of goods manufactured during the month? So beginning balance was what? 125. How much did we bring in? 835,000, because we just calculated that we brought that in because that was how much we had pulled for the new job. So we add those two together and we get the total that we're working on. It's telling us that we have 200,000 partially finished. So they're not done, they're not coming out, they're staying in work in process. So that's our ending work in process balance. So we're going to deduct that out. And the difference is 760,000. So when we take the 125 plus the 835, that is 960,000. And then we're going to take the 200 and deduct it. and come up with the 760,000. So that is the cost of goods manufactured. That's going to come out of work in process and move over into the finished goods. All right, so now we're in the finished goods section. Of course, we have a beginning balance. So beginning finished goods inventory was 130,000. The cost of goods manufacturing for the month was 760 that we just brought in. So we need to add them together to get what's available. And then it tells us what the ending finished goods inventory is, which is 150,000. So it wants to know what is the cost of goods sold for the month. So now we know how much cost did we sell. We've got to pull it out of finished goods because now we don't have that inventory any longer. So we're going to add the 760 plus the 130. That's going to give you 890. And then we deduct ending inventory of the 150. And so we have cost of goods sold. The difference is 740,000. So it's B. All right. So we're going to talk a little bit about the over under applied. So remember, the manufacturing overhead accounts has actuals going in as debits, and we have that estimated applied amount that's going in as credits. Well, now we got to look at the two and compare, okay, to see what the difference is. So the difference between the overhead cost applied to the work in process and the actual cost of a period is referred to as either under applied or over applied, right? So maybe we estimated too much, maybe we didn't estimate enough. So under applied overhead, that is when the amount of the overhead applies to jobs during the period using the predetermined overhead rate is less than the total of overhead actually incurred. Okay, so that's under applied. That means that we didn't put enough into that estimated amount and it's not enough. Over is the opposite. So over applied means that on the overhead of the jobs, I've estimated the predetermined rate to be greater than what the actual is, and I put too much in. Okay, so we have over and we have under. All right, so we're going to look at this and compare. So we have pair companies' actual overhead for the year was 650,000. And we had a total of 170,000 direct labor hours worked on the job. So remember, we need that activity base to know how to calculate what it's going to be. So it's saying the predetermined rate is $4 per direct labor hour. So we got to multiply the $4 times the 170 to calculate what did we estimate, because that's how many hours we worked. And that's how we're going to use it when we're going through the period. We're looking at those hours to calculate based on $4. So the 4 times the 170 is 680,000. So the actual is less. So does that mean I over or under applied? And my estimate was 680. My actual is 650. What? Okay, so it's more. Your estimate is more than the actual. So you're using estimate. So did you over apply or under apply? Over. Okay, so if we over apply, that means we did too much. We got to pull some of that back. Does that make sense? So if the actual number is lower than the estimated or the applied, however it words it, then that means that I over applied. I brought in too much. Okay, so this is just telling you that it's over applied by the 30,000. It gives you the example. So we're going to look at, you know, what do we do with that 30,000? There's a couple of different things we'll do, and we'll get there in a couple of slides. All right, Tiger Inc. had actual manufacturing overhead at $1,210,000 and a predetermined overhead rate of $4 per machine hour. So they're using machine hours. Tiger Inc. worked 290 machine hours during the period. So Tiger's manufacturing overhead is, so we want to know if it's over or under applied. So we have to calculate it out to figure it out. It's telling us 290,000 hours, and it's telling us $4 per machine hour. So we multiply it and get, I know I did this, I remember doing it. I wrote the slide numbers, but this doesn't tell me the slide number, I don't think. It's gonna be 1,160,000. Is that what you got? Okay. So the predetermined overhead rate calculation means that that's what we're applying. That's our estimate. Our estimate was 1,160,000. The actual is 1,000,002. So the actual is more. So did I over or under? So we did under because we didn't put enough. By how much? You got to get the difference. So the difference between the 1,210,000 and the 1,160,000 is 50,000. So it's 50,000 under applied. Okay. So my actual is more. So that means I'm under. If the actual is less, that means it was over. Okay. So if you want to just remember that to help you. Actual is higher. That means that I'm under applied. If the actual is lower, that means I over applied. All right, so there's two different ways we can take care of the difference. So we can put it in all of it in cost of goods sold, but we're looking at three different accounts, right? We have the work in process, the finished goods, and we also have the cost of goods sold. So not all of what we're applying is for the finished products, because remember, we're doing that as we're putting things into work in process. So some of the things that are costed, they're going into the manufacturing overhead as applied, those are happening on jobs that aren't complete yet. So some of it's for finished goods, some's for work in process, and then some of those finished goods have moved out because we sold them and they're in cost of goods sold now. So we really have three different places that we can allocate some of the 30,000. It doesn't have to all go to cost of goods sold. You can choose to do it that way. It's easier, and they just lump it all into cost of goods sold, but maybe that's not as accurate, right? You're trying to get your financials as accurate as possible. So maybe you want to try to allocate that so that the costs are allocated a little bit better and you won't have that big discrepancy. Maybe this one is a lot larger than some of the other discrepancies. And so you have one period that has a really large amount. Maybe the next period doesn't have a very large amount because maybe you estimate it right. So let's look at those and see how to allocate. So we're going to look at the journal entry and the T accounts, and we're looking at the 30,000 and we're going straight to cost of goods sold. So we have cost of goods sold and we have the manufacturing overhead. So let's look at what's happening over here. So for our first example that we did, we had actual overhead of 650, which is debiting. Then we have our applied, which is 680, which is more. So we over applied. So right now I'm sitting with a $30,000 credit on the books. So in order to get rid of that, I have to debit manufacturing overhead to bring this account to zero. Okay, y'all understand that part. Then I have to move it over to cost of goods sold because that's where I'm putting it. The whole thing's getting absorbed to cost of goods sold. So I'm debiting overhead and I'm crediting cost of goods sold. That's gonna be my journal entry. So this is just showing you the T account, what's happening. All right, so then we have an allocation of under applied or over applied between the three that we talked about. Work in process, finished goods, and cost of goods sold. So we got to figure out how are we going to calculate that out. You have to know what the balances are in those three accounts in order to do it. So they're telling us we have work in process of 68,000. We have finished goods of 204,000. And we have cost of goods sold at 408,000. So you want to list all three of those out. So this is what I find to be the easiest way to do it. So we're going to do work in process. Oh, that's weird. It's erasing part of what I'm writing. Why is it doing that? Okay. Pen. I don't know. It's not liking it. It hasn't done that before. No, it's not gonna work. So let's bring up a blank paper. Okay, so we have our work in process, which was 68. I can't see it. Can you see it now? Okay. So we have work in process, finished goods was 204,000. And then we have our cost of goods sold, 408. So we gotta look at the total. Okay, so I need to figure out what percentage is in each one of the accounts that makes up that total, right? So I'm gonna take 68,000 divided by 680, so I have 10%. Then I'm gonna do my 204 divided by my 680, and that one's 30%. And then I have my 408 divided by 680, so that should be 60% to come up with 100%. So I'm just using the totals so I can figure out what percentage of the 30,000 is going to go in each one of those accounts. So this is how we're allocating. So what was my amount? It was 30,000. And in order to figure out what accounts it's going to go in for how much, I got to do the calculations for that. So I use the total to come up with the allocation. Once I have the allocation percentages, that's what I use for each account for the 30,000. So I'm going to do 30,000 times 10% for work in process, times 30% for finished goods, which was 9,000, and then 60% for cost of goods sold. And that's my 30,000. Okay, so not too bad, right? We just have to look to see what were the totals in each one of those accounts and figure out the percentage, and then go back to what was the over or under. Take that amount and allocate it by those percentages. Okay. Okay, so these are the slides to show you how to do that if you need to get back to them. All right, so here's a journal entry. So the manufacturing overhead, we know that it has to have a debit because we had a credit sitting in there for that 30,000. So in order to clear it, we got to do the debit for manufacturing overhead for the full 30,000 to bring it to zero. Instead of the credit of 30,000 going all to a cost of goods sold, now we're allocating. So we have work in process credit 3,000, finished goods credit for 9,000, and cost of goods sold for a credit of 18,000. You have any questions on the allocation? Okay, so they're just saying there's two methods, go all to cost of goods sold or to do the allocation. And they're just saying here that it is more accurate to go into each one of those accounts. And we kind of talked about that just a second ago. All right, what effect will the over applied overhead have on net operating income? So if I've over applied, that means I put too much in potentially to that cost of goods sold. So what do you think happens to that net operating income? Do you think it's going to increase or decrease if I didn't put enough cost in? I think if I over apply the overhead, the answer is net operating income will increase. And so I'm trying to make sense of that in my head. So if I have the effect Okay, what effect will the over applied overhead have on net operating income? So potentially it's going to increase because when I over apply, I'm going to have to do the entry that we just did where I'm reducing the manufacturing overhead, which means I'm reducing my cost, which means I'm increasing my income. So once you fix it, that's what happens. Your income will increase. And it doesn't give any explanation, but that's what I'm thinking. If you over apply and you don't do the adjustment, let's just say you over applied and you don't do the adjustment, that estimate's sitting there. Now you have kind of a balance left in that manufacturing overhead, which you wouldn't want to do. So you would have to fix it. And so in order to fix it, you have to debit manufacturing overhead, credit cost of goods sold. So since you're crediting cost of goods sold, that means your cost is decreasing, means your income is increasing. So if you do the opposite where you've under applied and didn't put enough, well, now I have to add more into the cost because I'm going to have to credit manufacturing overhead, which means I'm debiting cost of goods sold. And if I'm debiting cost of goods sold, that means my costs are going up. That means my income goes down. So if I under apply when I do the entry, it goes down. Okay, and that was the last slide. So let's look at the homework real quick. Oh, I don't know why it's making me sign in like I'm new. Oh, maybe it's going to remember. It's a lot of clicks to get there. Almost there. All right, so we're in chapter 3. I think the problems are further down. Just wanted to look at the problems real quick just to make sure I don't want to discuss anything with you. Okay, so on problem 6, it'll be some journal entries. And it's just giving you 4 different things that have happened. So it's saying 89,000 in raw material was purchased. So you have to do the journal entry for that. So it's just going to give you that information so you can walk through the slides if you get stuck to see how to do those journal entries. All right. This, the problem number 7, you're preparing the T accounts. So you're going to be looking at each one of those accounts, and it's going to give you these different transactions that happen. So we have 75,700 in raw material that was purchased for cash. So you have to put it on the T account. And in this case, because they're telling you that and they're giving you all the accounts, you'll do both sides. If I'm paying cash out, then I'm doing a credit. So I have a credit of 75,700 here for A. I don't know, have you looked at the homework yet? Okay, because I don't know if it's going to make you put the A next to it or not. So just keep that in mind. It's looking for the amount here and maybe possibly, you know, identifying what entry it's for. And then if you bought materials, we would go to the raw materials account and we would put, you know, for A, we're buying 75,700. So you'd have to enter it in. Okay, so you're just basically entering in your T accounts. And then for 2, you're gonna look for the adjusted cost of goods sold. All right, so once you put everything in, you'll be able to come up with the cost of goods sold based off of that T account. Okay, so you just basically enter it and pull in the balance here. I don't know if this is going to add for you. It might, as you put it in, it may add up for you. You don't have to put the total in, I don't think. It looks like it from when I hover over it, it has a sum formula in there, so it's probably adding for you. All right, so you're just going to be entering on the T accounts. And then number 8, so we have the cost of goods manufactured and the cost of goods sold. So we'll have all of the information you need for the production. So you have your raw materials, your indirect materials, direct labor. It gives you your inventories because you may have to calculate using that formula that we did on that slide that tells you how to calculate the beginning plus the purchases, and then less what you have left to come up with cost of goods manufactured or cost of goods sold. And then you just basically filling out your schedule. So you have your materials, it's telling you beginning, raw materials. I'm not sure, I think that this, because it's got a drop down menu, I think you're gonna have to select. You'll probably have different ones to choose from. And then remember, you always have the practice homework too. Like if you wanna go into the practice and do, try it and hit submit and see what it comes back with if you get stuck on that real homework. All right, so you're gonna select your account and then you're gonna put your number in. So it's telling you raw material inventory in the beginning. All it's doing is pulling your beginning balance here. I don't know why it's not letting me out. Okay, there it goes. And remember what we did for materials on that slide. We did your materials that you begin with, you add your purchases. So we're just pulling what did we purchase, and then you get your total available. Then you go through and you pull out what was ending inventory, and they're telling you over here what was ending for raw material, 19,700. So you're just keying in those numbers and doing those calculations. All right. And then we have the direct labor. So you would do the same thing. Then you have your cost of goods manufactured in the end. So it's walking through the slides that we did for the lecture. So it should be helpful when you fill in these out. Okay, so you're doing your schedule. And then for the second part, you're going to prepare the schedule for the cost of goods sold for the month. Okay, so you have to know what was in my inventory for my finished goods. When you're looking at cost of goods sold, that's telling you I'm pulling out of my finished goods products, and that's my cost of goods sold, because I'm not selling what's in work in process, and I'm not selling what's in raw material. Does that make sense? I'm selling that product that's in that finished goods section. Over, under, applied. So we'll calculate it and you'll figure out if it was over or under. Okay, and this one is over or under, and it's also got the schedule again for the cost of goods manufactured. All right, so keep in mind, if you know how to do this, you should be great for the test, because we won't obviously have time to fill out anything in that great detail. So we'll do pieces of it. But anyway, so this one is assume the following, and it's giving you your information on there, and it says, what is the amount of indirect materials used in production? So then you would have to calculate that out. So remember, the indirect and direct materials all comes from that raw materials. So you would pull all of it, right? And then when it tells you what the direct materials used in production are up here in the given, you would pull that out, and the difference from what you had in that amount is going to be your indirect. So remember that that total is both indirect and direct materials coming out of raw material. All right, so do y'all want to do any of these, or do y'all feel comfortable? You good? Okay, do y'all have any questions?